Sharp Company must evaluate the post-project to produce printer cartridges. The equipment would cost $55 plus $10,000 for installation. Annual sales would be 4,000 units at the price of $50 per cartridge, and the project's life would be 3 years. Current assets would increase by $5,000 and payables by $3,000. At the end of 3 years, the equipment could be sold for $10,000. Depreciation would be based on the MAACRS 3-year class, so the applicable depreciation rate would be 33%, 45%, 15%, and 7%. Variable costs would be 70% of sales revenues. Fixed cost, excluding depreciation, would be $30,000 per year. The marginal tax rate is $40,000 and the corporate WACC is 11%. Good luck!
Greetings, trainers! To understand NPV in the simplest form, since this is an investment, it is a cash outflow which can be taken as a net negative value. So it is also called an initial outlay. So for the Sharp company, it would cost them $55,000 for equipment and $10,000 for installation. And the change in net working capital, which is $2,000, came from the difference of current assets that increased by $5,000 and payables by $3,000, which would then total to investment in year 0 of negative $67,000. Stand by.
Greetings, trainers! The annual depreciation is the yearly rate in which depreciation is charged on an asset. In this project, modified accelerated cost recovery system is used to charge annual depreciation. Thus, the rates from years 1 to 3 are 33, 45, and 15% respectively. With the asset cost $65,000, the annual depreciation from years 1 to 3 are $21,450, $29,250, and $9,750 respectively. After calculating the annual depreciation, the next trainer will give detailed information with regards to the projected cash flow. Stand by.
Greetings, trainers! The annual net cash flow is the amount of cash generated by the company over a period. It also refers to the difference between cash inflows and outflows of the business, an increase or decrease in cash and cash equivalents. Given the $67,000, which is the initial investment, equipment depreciation expense of $21,450, $29,250, $9,750 for years 1, 2, and 3 respectively, and other projected calculations and factors, the project's cash flow is approximately $26,580 in year 1, $29,700 in year 2, $31,720 in year 3 accordingly. So for the next trainer, Let's find out if this project should be accepted. Stand by.
Greetings, trainers! As seen on the previous line, the project's net present value is calculated by adding negative $67,000 to $26,580 divided by 1.11 raised to the power of 1 plus $29,700 divided by 1.11 raised to the power of 2 plus $31,720 divided by 1.11 raised to the power of 3, which totals to $4,245. According to the net present value theory, investing in something that has a net present value greater than zero should logically increase a company's earnings. Since the result is positive and greater than zero, then the project should be accepted in which the sharp company can expect a profit. Stand by.
Greetings, trainers! Net present value or NPV is a method used to determine the current value of all future cash flows generated by a project, including the initial capital investment. It is widely used in capital budgeting and investment planning to analyze the profitability of a projected investment or project. To calculate, an NPV is when you add and subtract present values. Add each present values you receive and subtract each present values you pay. As for the given, $67,000 is the initial capital investment, followed by $19,380, $22,500, and $24,520 for years 1, 2, and 3's project cash flows respectively. As for the computed NPV, it resulted to negative $13,350. A positive net present value indicates that the projected earnings generated by a project or investment in present dollars exceeds the anticipated costs, also in present dollars. The NPV is negative, hence the project should not be accepted. If unit sales were 20% below the forecast level, the project would no longer be accepted.
Greetings, trainers! The standard deviation is a statistic that measures the dispersion of a dataset relative to its mean and is calculated as the square root of the variance. To solve for the best case scenario, given that the unit sales is 4,800 with 65% variable cost and other variables remain unchanged, there would be a project cash flows of 40,980 for year 1, 44,100 for year 2, and 46,120 for year 3. Using the net present value formula that was previously shown, a result of $39,434 net present value for the best case scenario. As for base case scenario, given that the unit sales is 4,000 with 70% variable cost, there would be a project cash flow of 26,580, 29,700, and 31,720 for years 1, 2, and 3 respectively, which equates to a net present value of 4,245. While for the worst case scenario, considering that the unit sales is 3,200 with 75% variable cost and other variables remain unchanged, an approximate project cash flow would be 14,580, 17,700, and 19,720 for years 1, 2, and 3 accordingly. Therefore, the calculation for the net present value for the worst case scenario is negative $25,080. Using the sum of the net present values of all three cases, which is 39,424, 4,245, and negative 25,080, which totals to expected net present value of 5,711. As for the standard deviation, it resulted to 22,856 with 4.0 coefficient of variation.
To conclude, managing risks on projects is a process that includes risk assessment and a mitigation strategy for those risks. Risk assessment includes both the identification of potential risk and the evaluation of the potential impact of the risk. Sharp Company's project and risk analysis aims to examine the aspects of a project in details. This is mainly to see to it that the project will run as expected and is also within the predefined budget. Also, they intend to identify and manage potential problems that could undermine the key business initiatives or projects. To carry out this analysis, the company must identify the possible threats that they may face and then estimate the likelihood that these threats will materialize. The results lead to having a positive net present value. In general, the said evaluation of the project presents potential risks that may have several impacts. This only goes to show that risks cannot be simply avoided. However, the expected net present value of the project projects a positive result. This means that the project would or can still be accepted.
It's a battle, win or lose. It's the friends you make, it's the road you choose.